Hi, everybody, and thank you for coming to our 10 Capital Family Office Roundtable. My name is David Welch. I work investor relations with 10 Capital, and today we're going to have a discussion over economic trends in family offices. And after that, we will go into a Q&A and do one of our family office startup deals. So to get it kicked off, I'd like to introduce to you Charles Patrick Murphy of Liberty Park Capital. Charles, if you'll tell me a little bit about what you do.
Sure. And thanks for having me. So I started Liberty Park about 12 years ago. I've been working on Wall Street for 20. Most of my background before Liberty Park was in small cap equity research. So I think the big mutual fund families, Fidelity, T. Rowe, Capital Group. So I used to advise them what small caps to buy and sell, and then I started my own firm, Liberty Park, in 2012 to do the buying and selling myself. So the focus for Liberty Park historically has been on small cap publicly traded companies, where we've known the business and the industry and the management team for many years, and feel like that kind of gives us a strategic advantage relative to sort of Joe Schmo, who's just looking at the stock for the first time. In my opinion, if you're going to ask people to pay you to manage their money for them, you should be expected to give them a return that is superior to what they could have gotten from an index fund. And I think markets are mostly efficient. So if you're going to kind of try to play the game of beating the market, it should be with companies whose stock prices are more volatile, and the companies themselves are less understood, and so that's how you get the mispricings, and hopefully somebody like me can kind of capture that mispricing.
Right, understandable. So going into our discussion, one of the questions I wanted to ask you, and I think you would be the perfect one to ask on that, is how do you see the current economic climate in impacting family offices in the next 1 to 3 years?
Current economic climate affecting family offices. So I mean, like, I think at a very high level, like, what do I expect markets to do? If we're talking very near term, next 3 or 4 months, we're probably going to go sideways. On one hand, we have what is known as the Fed put in play, meaning that if the economy gets much worse or markets fall off hard, the Fed is pretty much there, ready to cut interest rates to stimulate the economy. The catch is inflation is still running hotter than they would like. They want target is 2%. We're still at 3+, and so the chances are we're not going to get a rate cut right away. I think we'll be lucky to get one in September, but kind of until then, we're sort of in a all right economy, but not great. Rates are much higher than they were 3 or 4 years ago, and obviously that significantly constrains investment and economic activities. So kind of until that's done, or until we have a new president in place, I don't see a imminent catalyst for a better economy or better equity market, and that obviously kind of filters or trickles down to the rest of the financial markets as well. So well, whatever the case is for public equities, you could bet that it's double that for private equity, and even further out on the risk curve, something like venture.
Okay, and with that, what macroeconomic factors should family offices be aware of? What do you see?
Again, I think sorry, fix my phone there. Again, I think the most important one is interest rates. Okay, like, the risk-free rate sets the tone. Everything else is built off of that risk-free rate. What the Federal Reserve is doing with interest rate policy, and yeah, again, everything else kind of trickles down from there. So until we see an interest rate cut, I think a cut is probably more likely than a hike in the next 12 months. But without a doubt, your question was what economic factors. That is far and away the most important one. Inflation is kind of part of the same equation, and so that's another thing to be mindful of. It's come down after the Federal Reserve hiked rates in 22 and 23, but it's still lingering. First it was if you go back to COVID, right? The Reserve pumped trillions of dollars into the financial markets to basically save the economy and keep everyone afloat. Well, then you had kind of the COVID mania in terms of people being locked up at home for months, and then wanting to live like there's no tomorrow. And so that's basically what you saw in 2021 and early part of 2022 was people spending like there was no tomorrow, and that creates inflation. When you have both supply of money and velocity of money being spent, that's what creates inflation. It is coming back down now, and so that is a good thing to see. But we're kind of not. The coast isn't clear just yet on inflation. It started with goods. Now it's been sticky in inflation, or excuse me, in inflation in services. So we'll see. Hopefully, services inflation cools off a bit too, and that's what'll give the Fed kind of the data that they need to cut rates later this year.
Right. What strategies could you offer or suggest to a family office setting to help mitigate some of the risks right now?
It's a good question. Let's think about it for a moment. I mean, look, when rates are high, we talk about it a lot in my office. We have two funds focused on small caps today. We're also getting into private markets, but that's kind of the next phase of the business. But for our legacy business, we have a hedge fund and we have a long only, both focused on small caps, and small caps, short of venture, are about as far out on the risk curve and volatility as you can go. And for our hedge fund, like our historical kind of bogey target return was sort of 10 to 12%. We can talk more about it later, but when I look at the private credit markets, they can get 12 to 14% taking credit risk as opposed to equity risk. So much less volatility, much less risk, frankly, with that 12% return. So, if anything, if I had any advice, if you were trying to avoid risk or just get a good risk adjusted return, I think private credit is a pretty good place to look these days. And people certainly have talked about is private credit a bubble, and has it grown? Without a doubt. Do I think it's a bubble that's about to burst? I definitely do not. There might be pockets of it, something like sponsor led credit for like LBOs, maybe that area might be due for a correction, but I don't think that the trend towards non-bank lending is going away anytime soon.
Okay. And with that being said, do you, on your mind, do you have any emerging markets or sectors that family offices should pay attention to, something on the horizon?
Emerging markets. When you say emerging, do you mean outside the U.S. or just like markets that are up and coming?
Just markets that are up and coming, just in general. It can be outside of the US, but something that's on our soils also effective.
Sure. Yeah, I mean, I wouldn't say like I'm super, amped about anything outside the U.S. Not to say that there aren't opportunities, but there are so many ways to make money in the U.S. It's just kind of not worth the the headache, the amount of labor, and the risk, to look outside the U.S. In my opinion, within the U.S., yeah, I'd say the 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 big structural shift that's underway is kind of a move away from big banks, and kind of Wall Street into sort of decentralized finance, right? I mean, you hear all the time about crypto, but uh, yeah, I mean, just kind of basic capital markets activity is moving away from the big JP Morgans and Citigroup and Wells Fargo's of the world. Part of that is a function of post uh, GFC, Great Financial Crisis, um, of '08. That after that there was a lot of new regulation in terms of what kind of loans and investments that the big banks could make, and so they were forced by the government to get out of those businesses. The other part of it is that they're underwater on some of the loans that they made in the low interest rate environment, and they're now trying to uh, simplify or liquidate some of that portfolio. But basically, what you've seen is you had trading desks at the big banks, you had portfolio loans and such, and both of those activities have moved to mostly, I call it the fundification movement. Basically, now the primary investors and lenders are funds as opposed to banks.
Okay, and with that, would you say that family offices should change their investing strategies, or should they carry on with what they've currently been doing? Have you been seeing a change in the way investments have been handled in family offices?
Yeah, I mean, I think family offices should think of themselves as the new banks, as the merchant bank that can be more flexible and nimble with their capital and get great returns as a result. Again, when you can make 12 to 14% in private credit, taking credit risks instead of equity risks, should be doing that all day long. And so I would encourage family offices again to think, okay, what areas of the financial system used to be serviced by the big banks that are no longer really serviced by the big banks, but the people who used to get the money from the banks, they still need the money, and you, the family office, can be the one that provides it to them, and you can get a better return because their demand for capital is greater than what the supply is now, with the banks leaving the arena.
Okay, and piggybacking off of that, this is a question from the audience. How are family offices qualifying seed stage startup investments at this time? And are impact investments still a motivator?
Yeah, I mean, I'm not a big. I certainly know plenty of venture capitalists, but I wouldn't really say that I personally am one. Look, I think the deal with venture, okay, I mean, you had easy money for a really long time, and software was eating the world, and we had COVID that really accelerated, everything being on the internet. We now have work from home, still plenty of the workforce working remotely. Um, so there were lots of things in favor of technology as a sector and venture as an investment. Um, when interest rates got hiked, that changed. Okay, when money is free, i.e., interest rates are pretty close to zero, getting a dollar 10 years from now isn't really any different than getting a dollar today. And so, I'm willing to pay you or give you a valuation that hey, if you give me that money eventually, sure, I'll I'll factor that into your valuation. But if in the current regime of a 5% 10-year Treasury, well, now I'm going to heavily discount what you're making in 5 or 10 years because my cost of capital is at least 5%, probably more than that. And so investors definitely are more interest rate sensitive and liquidity sensitive. And so, look, I think I'm not a venture capitalist, but I do know a thing or two about financial markets, and I think you get at least another year or two before venture kind of comes back into vogue, or even some kind of moderate level of success with fundraising from family offices and from everybody.
So are you seeing this inflation affecting the asset allocation and investment returns majorly, or how are you seeing that?
I'm sorry, what was the last part of that question?
How are you seeing the inflation affecting the asset allocation and returns on investments?
Well, again, the inflation, where it's mostly important is as it relates to Federal Reserve interest rate policy. If inflation is above 3%, which it is, the Fed is probably not going to be cutting interest rates. If inflation does get down to 2% target, then they can start thinking about cutting interest rates. But again, if what's important is what direction Federal Reserve interest rate policy is going, that is why inflation is important. I don't know if I answered your question.
Yeah, yeah, I think you got it. I've got one question here from the audience that I want to ask. How do you see the trend of family offices to craft a desired future by adding impact to the financial return metrics to leverage their investment, putting the money where their mouth is? And that was one from the chat.
Can you repeat that one?
How do you see the trend of family offices to craft a desired future by adding impact to the financial return metric to leverage their investment?
Impact, yeah. I mean, look, it's tough. I think there's probably strata within the family office space. So I'd say if you've got 50 to 500 million, impact is probably less important to you. If you're above 500 million, money ain't a thing, and so they can probably do more impact investing and not need to see, or kind of a financial return is not the number one priority. So I mean, to me, impact investing is kind of like philanthropy. You want to see people doing it, but you don't go necessarily into it with return on investment as the highest priority. And so, I think there will always be impact investing, and people want to put things that they're passionate. They want to amplify it and uplift it, and so I think it will always be there. But it's like a hyper individual. It just varies significantly from person to person. And so I couldn't tell you, how do I think, where is diversity going to rank in investors' preferences? I'm not sure, like versus environmental stuff, or lots of different things that people do with impact. I couldn't tell you how the priority list is going to look in the next few years. Again, it's just a very individual driven thing.
Right, right. Okay, and this is also another question from the chat. We may be going back a little bit. It's one that I missed, but are you an advocate that small cap equities, due to the fact that small cap markets are less efficient, can produce higher alpha than mid or large or mega cap stocks?
Yes, I am. Um, yes. Small cap has been in the doghouse the last 10 years. But I'm of the view that everything is cyclical. Everything has a mean reversion. Small caps outperformed large for 80 years, something like that.
Mhm.
It has underperformed the last 10. I think that is partially a function of so many companies staying private for longer, as opposed to growing, while publicly owned. Um, I suspect that yeah, you're going to see a lot of venture and private equity folks. Their investors are going to want their money back. They need liquidity, and so that'll sort of force their hands to push their companies back into the public markets as opposed to in private hands. And so that could be, if I wanted to predict a trend for the next 2 or 3 years, I think that there's a reasonable chance of that happening. But yeah, I mean, look, I think to my earlier point about if you're asking people to pay you money to manage their investments for them, they have a right to assume that you're going to give them something superior to what they could get with an index fund. I think it's really hard to beat the thousands of investors who traffic in Apple and Google and Netflix. If you looked at our portfolios in small caps, I'd be surprised if you had heard of any, of our 30 or 40 names. And so that just kind of inherently or structurally gives us an advantage when I've been looking at these companies for 5, 10, 15 years and know the management teams on a first name basis. Uh, yeah, so I think it's always important that you have some sort of edge, and we do have it in small cap.
Fantastic. And kind of piggybacking off of that, one of the questions that I personally have is how do you see technology changing or affecting family office investment? Do you see it being more productive, being able to see more deals, or is this something that's going to be a hindrance in the future? What do you see?
Yeah, I mean, look, everybody is interested in private markets, and not so much public or liquid markets. And same goes for me. I'm interested in privates too. Um, but I think what you're going to see in the private markets is sort of a commodification of the asset class, kind of like you saw with stocks. Vanguard, John Bogle basically made it available, an index fund available to everybody for practically free. If you go back 40 or 50 years ago, I mean, a mutual fund cost you 3 to 5% a year in management fees, and I think you're going to see a similar phenomenon play out in the private markets, where you're going to see sort of a realization that picking the winners and avoiding the losers is really hard to do. And what you're really better off doing is trying to get diversification and focus on reducing cost of accessing the asset class. And so that's actually kind of my next project personally, for my business, is doing exactly that, trying to provide a Vanguard like solution for the private markets. And so, you asked about technology. I think technology will enable that.
Now, do you see any newer technology, maybe emerging technology, fintech or blockchain ever being integrated into a family office? Is this something that would be on the horizon, or are we just looking at not really?
Look, I was optimistic about blockchain. I'm not really sure, to be honest, why it hasn't had any real applications yet. Yeah, I think that's the case. I can't think of anything where blockchain, this application is all in blockchain. Can't think of anything. Fintech, I mean, it's kind of a buzzword. Uh, Using technology in financial markets. There's kind of always been technology in financial markets. Uh, so I guess it sort of depends on what we're talking about. I think technology will allow investors to sort through the opportunity set faster and more effectively. Um, will we get to a point where AI just builds the portfolio for you? Yeah, maybe one day. But I think there's very few people who are interested in it taking the wheel today. Um, so I view AI as mostly helping humans do their jobs and be more productive. Yeah, I'd say it's a productivity enhancement tool as opposed to a self-sufficient, self-operating tool. So
Okay. And before I get too far away from it, we did get a question in the chat. Can you elaborate more on your Vanguard solution for the private market leveraging technology?
yeah, if any of the viewers are familiar with Case or iCapital, I would say that what they're trying to do is similar to what Morningstar used to do, or I guess kind of still does, which is create a rating system. Morningstar did it for stocks and for mutual funds. What you're seeing Case and iCapital do is kind of similar for private equity and private credit funds, and I guess maybe some hedge funds. And what I'm trying to do is, again, this kind of fool's errand. We learned this in the public markets that, again, what you should be focused on is more about uh, diversification and sort of capturing the benchmark and driving down the cost of capturing down the benchmark so that you actually get the benchmark return, not benchmark minus fees. And so they kind of have one idea of how to use technology, which is to sort of create a marketplace for private funds. My idea is to use technology to, again, create more of the index fund to where, with kind of the click of a button, you can get a very diversified portfolio of private equity, private credit, esoteric, absolute return, infrastructure, and real assets.
Okay, great. And from my end, something that I did have a question about is on the horizon, is there any regulatory changes coming? Anything that family offices should be aware of near future that would affect them? I'll leave that open to you.
Well, obviously, the idea of a wealth tax has been kicked around for a while. I saw the other day that I think it was maybe Italy and France proposed, having some sort of global tax on billionaires. And Janet Yellen rejected it out of hand. So I think taxing unrealized gains is just inherently problematic. So yeah, I would imagine something tax related would be the most important that is specific to family offices. I'm not a CPA though. I'm trying to think of other things. Yeah, I mean, I think the big theme in financial markets is sort of the debanking fundification trend.
Okay. And that's everything from my end on the discussion. I would like to open it up for a Q&A. If anybody had any questions, you're welcome to put it into the chat. We can have our great panelists here answer any of your questions, anything that you may want to know on family offices. And while you are coming up with your questions, I did want to ask uh, Charles, is there anything that you want us to specifically know about family offices that we currently don't know or that could help impact us?
Yeah, so I heard a friend recently say, like, you know, most of his business was he was another public equity fund manager who's raised several $billion from institutional investors, and he said, kind of, if you've met one institutional investor, or one pension fund or one endowment, you've probably met them all. Whereas you meet one family office, you've met one family office. Implying that they're all different, and I think that's correct. Everybody has different, motivations and profiles of their wealth. I mean, a lot of people look at something like real estate, for example. They might have enormous balance sheet wealth, but pretty low liquidity. Uh, and same thing if you're a tech founder, and your valuation might be a billion plus, but I get a friend who is that, but 95% of it, his wealth, is still in the company, and until he sells it or goes public, he's not able to invest with you in a meaningful way. He's mostly got to focus on putting his cash into things that can give him some sort of supplemental income. So yeah, that's what I'd say. It's just kind of every family office is different, and meaningfully different.
Do you have any tips or tricks for a family office that would want to network or get to know other family offices? That is kind of one of the questions I do get out there in the world today is how do I get to meet other family offices? What do I do?
Yeah, no, I mean, like, it's something that when I was getting my firm started, I spent a lot of time asking that question and seeking family office introductions myself. The reality is that most family offices do they're private. Uh, they do not. It's frankly a security risk for them to be known far and wide. So they're not flaunting their wealth and asking people to find them and ask them for money. That they're usually doing the opposite. They're trying to hide, and they don't want you pinging them. So, uh, my best advice is just networking. When you find one person from a family office, you try to schmooze them, and hopefully they like you and want to introduce you to some of their friends. But there are very few real databases of family office. There are plenty that claim to be family office databases, but usually the information, the emails, the contact information is stale. It's not even usable anymore, or it's for people on their staff as opposed to the family members themselves.
And maybe this is kind of bringing it back a little bit into the discussion, but you did bring something up that I did want to talk about is how does family offices, now that we have all this technology that's being integrated into them, now that we're all using it, how do family offices kind of mitigate around being hacked or get their information stolen? Because it sounds like that is an important part of it.
Yeah, I mean, yeah, identity theft is something everybody deals with, family office or not. I know I personally just kind of like try to stay off the grid, both for my business and personally. That's to me like a starting point. Is the fewer people who know who you are, the less of a target you'll be. But yeah, I mean, I got that question the other day from my dad, asking, like, could we ever be hacked, and is our money in danger? And for our sake, our money is in funds, and the funds are held. Uh, well, our funds are invested in businesses and equities, publicly traded equities, and so it's kind of hard for somebody. It's not really even possible for somebody, even if you hacked me, you would have to sell the shares that I own. then hack your way into the bank, and then it's just not going to happen. And there's multiple authentications that have to happen along the way. So uh, you can hack my website all day long. You're not really getting anything from it. I mean, it's just for information purposes only. There's no money there. The money's all at banks, and we're using their kind of security infrastructure as opposed to our own.
Right, that makes sense. Well, that's it from my end, Charles. Thank you so much for the discussion and giving us the insight and being a great panelist. I am going to transition over to our startup pitch event, our startups pitching. So I would like to bring up Mike and David of Foreign Medical.
Okay, thank you very much. Let me share my screen. Yeah, absolutely. Thank you very much, David, for the opportunity. And Charles, great presentation. Thank you very much. Tell you a little bit about Curating Medical. My name is Mike McCormick, and I'm the president of Curating Medical. And our mission is to protect patients' lives and limbs through the early diagnosis of peripheral artery disease, or PAD. An estimated 12 million Americans suffer with PAD and has a 33% mortality rate within 5 years. It's a progressive disease, and it can lead to leg amputations, and it costs the U.S. healthcare system $250 billion annually. The good news is that PAD is preventable with early detection. Medical guidelines recommend the ankle brachial index test, or the ABI, as the primary screening tool for PAD. There are approximately 1 billion patients globally who are indicated for PAD screening, yet only 20% actually receive an ABI test. This bottleneck in PAD screening is caused by poor ABI testing alternatives. On the left is the gold standard, which is an ABI pencil probe, but it requires a certified vascular technician and is difficult to use. On the right is oscillometry or plasmography. It is very easy to use, but it doesn't follow medical guidelines and it's not reimbursed. There is a large unmet clinical need for a fast, simple, accurate, and easy to use reimbursable test for PAD screening. Introducing the UltraSense system. It's a breakthrough AI ultrasound technology with a unique combination of accuracy and ease of use, allowing any healthcare worker to screen patients for PAD with a system that meets medical guidelines and is reimbursed through Medicare. The UltraSense advantage lies in its ability to automatically find the vessel. In the top left image, you see a standard ultrasound pencil probe used on a patient of average weight and tissue depth. The actual beams cross inside the vessel and bounce off the red blood cells, producing the signal. The image right below it is an obese patient, and you can see the beams are not crossing in the patient. That forces the vascular technician to manipulate the probe on the surface of the skin in the hope of finding the vessel. UltraSense, which is pictured on the right, has multiple elements that actually automatically find the vessel. This innovative approach allows any healthcare worker to effortlessly perform ABI testing in less than half the time that it takes with a traditional Doppler pencil probe. Obesity and swelling are the most challenging ABI scenarios, and it can lead to false positive PAD readings. Curating has addressed this challenge with stochastic resonance technology. On the top right image, you see the pulsatile blood flow, which is the purple line. Unfortunately, it's below the level of detection. The stochastic resonator introduces broadband white noise, amplifying that signal so that it can be detected. UltraSense will hear what other systems can't, which will improve accuracy of PAD diagnosis. Our proprietary AI technology drives our system. On the left, you see all the AI-controlled inputs, like the multi-element probe and the stochastic resonator that automates blood vessel detection. In the middle, you see our SmartSense AI diagnostic algorithm, which interprets all the system inputs and simplifies the diagnosis into an easy-to-read PAD status report. We thoroughly tested this system in the lab and on human volunteer subjects. On the left is our bench testing model of phantom tissue, arteries, and pulsatile simulated blood flow. On the top right is our published results of our very first test. We created a pencil probe just like the market-leading pencil probes. But you can see, gosh, we were able to develop a much more sensitive probe that had 50 and 67% increased coverage to the market-leading Doppler probes. Bolstered by these strong results, we developed the multi-element ultrasense probe, which you see pictured right below. It has 300% superior coverage to a traditional pencil probe. The total available market is large. It's 1 billion patients. You see it represented in blue. But as I mentioned earlier, only 20% are actually getting the test today. And that's represented by the SAM, or serviceable addressable market, in yellow of 205 million. The green represents the US market, and that's 113 million tests per year. There's a significant gap between that sum and the TAM, and that exists because of the limitations of currently available testing alternatives. Ultrasense will address these limitations. Our business model will be a SaaS business model with monthly billings of approximately $500 per month, giving us 85% margins over the 3-year useful life of our product. We will also offer optional consumable, which will have a margin of 50%. Corin will build its sales channel based upon partnering with very large commercial partners. And you can see a lot of those names across the bottom. We've already spoken with BD, Abbott, and Philips, and they've all expressed interest in distribution opportunities with our product. Turning to our key financials, you can see revenue commences in 2025 following FDA clearance, so about 1 year from right now. And we expect to reach cash flow positive or profitability in 2026. As you look at our revenue projections, many people will think, gosh, how did you build those revenue projections? We did this on a bottom-up analysis. So if you look at the upper left-hand image, you see the overall customer base in the United States. There's about 400,000 specialist primary care hospital outpatient clinics in the US. We know today all of them don't do ABIs, but about 25% do. So that's 100,000 customers that currently do ABI testing. We have a strong value proposition for all of those. We'll increase the speed and reduce the cost of the test. However, we know not all of them will upgrade right away. So we've taken 33% of that user base because that's how long systems last. They're looking for upgrades about every 3 years. So that's 333,000 customers looking for an upgrade. We're going to partner with a large player. You see all those players referenced on that upper right. And they all have about 100 sales reps each. So in the bottom left, you can see how we built our forecast. Based upon the 100 reps, we determined exactly how much sales we expect each of them to do per month. That's that first line on the bottom left. That translates into all of the units that you see placed. And then we checked, okay, well, what is the conversion of the available market in each year? So you can see it starts at 2% in the first year, and in 2027, we're at 11%. We compared this to a top-down analysis, which is the chart that's on the right. We know what the size of the market is, so we looked at that forecast from bottom up, built on units, and we checked it against the total size of the market, and the two are very similar. We feel we have a conservative and accurate forecast that's built upon ultrasound's clear value proposition. The way that we will go to market, our commercial launch, is going to be guided by the best impact that our system can have. And the American Heart Association publishes an amputation heat map that's related to PAD. These are all patients with PAD that end up with amputations. The unfortunately most adversely affected areas is Louisiana, South Texas, and Mississippi. And you can see on the right of this slide is different health systems that we are partnering currently with that are giving us design feedback at each step of the way, and they will also be the first markets that will adopt our technology. Our development timeline for the remainder of this year is all focused on FDA submission, which we plan in Q4. It will have a variety of testing.
Mom's printer.
What's that? I'll keep going. Manufacturing throughout the rest of this year. Our leadership team is comprised of serial medical device entrepreneurs who have an outstanding group of medical advisors also with a depth of business acumen. In fact, the physicians on this panel gave us a variety of new markets that the ultrasound could participate in. And this could give us a future opportunity of 10 million patients per year. With founders capital of 578,000, we've received provisional patents and proof of concept. And we're now offering a convertible note with a 20% discount and 10% interest convertible into Series A. We closed on 200,000 in March, and we are now seeking 1.3 million to fund FDA operations to FDA clearance, which is projected 12 months from now in the first half of 2023. Looking at value creation milestones and the value of the company at different stages, the company started in 2023 with just an idea and founders capital of 578,000. And in 2023, we were able to achieve proof of concept in that first year, as well as we established some patents. And then in this year, we are now offering a convertible note of 1.5 million. It's got a $7 million valuation cap, and it will fund operations to FDA clearance, which is in the first half of next year, about 11 months from now. FDA approval is a critical value creation milestone, and that's what will trigger us to raise Series A. And when we expect to raise Series A, about 12 months from now, we expect the pre-money value of Series A to be 12 to 15 million based upon the FDA approval. Simultaneous to that raising, we will also be discussing with industry distribution of our system. And obviously that could produce some M&A activity that could be in advance of Series A. The next value creation milestone after that will be cash flow positive, which will happen in 2026. And that also could trigger us to go to an IPO. I expect that to be at 5 to 7 times revenue or 60 to 80 million range. And in parallel to that, we'd also be talking to industry about an M&A. So that gives you a quick overview of Kilroy. We hope you'll consider joining us in our mission to save patients' limbs and lives with the early detection of PAD.
Mike, thank you for that. If there's any questions from the audience, you can post them now in the chat. I'll give it just a moment to see if there's any more questions. And I'm sorry, how much are you currently raising, Mike?
We are raising 1.5 and we closed on 200,000 in March, so there's 1.3 left.
Okay, so you already have a lead investor on it. And it doesn't look like right now there's any questions coming in through the chat. You do have a little bit more time if you have any more updates on your deal.
Yeah, a couple of updates are all around traction and some significant traction steps for us. The one that was a big one for us this week is some people may be familiar in Minneapolis or the Minnesota area. There is a competition called the Minnesota Cup. It is sponsored by the Mayo Clinic and the University of Minnesota. They have over 3,000 applicants that put in for the Minnesota Cup every year. It does have some cash awards with it, as well as a lot of publicity. We were selected as one of the semifinalists for that. So they select in the medical space 10 companies, and there was over 1,000 submissions for that. So we felt very good about that, and we're very pleased to be participating in the Minnesota Cup.
Fantastic. And I believe that is it for our startups pitching today. We will do a follow-up on if any of the family offices wanted an introduction or have any questions with Mike or David today. So thank you, and that'll wrap up our family office roundtable, and we will see you at the next one. Thank you.
Thank you.